It's Brian Preston, the money guy.
This next question is from Silent Strife. Sorry about that.
Is that passive aggressive?
I
Is
don't
that just
know.
another
Yeah,
way of
that's-
saying passive aggressive?
I guess. Hey, at the Money Guy Show, my job provides life insurance for up to $250,000, but our household is a $250,000 per year in a high cost of living area. So I think you're saying we have income of $250,000, and my employer provides $250,000 of life insurance. Do I need supplemental insurance? Do I need more insurance than that? I'm in my late 30s. So it sounds like I make $250,000, high cost of living area. My employer offers me one time salary, one times income, and I'm in a high cost of living. I'm in my 30s. Do I need more insurance than that?
Yeah, there's a lot going on in this question. First, I want to give a compliment to your employer because, realize your employer can do $50,000 worth of life insurance for you, take full deduction. Anything they do above that $50,000, they really like you because the government kind of takes away some of the benefit of the employer giving it to you. So they really like you to give you up to $250,000. But realize when we give guidelines on insurance, and this isn't just ours. I hear Dave Ramsey give this guidance and so forth, is that you take your income, you multiply it by 10, and then now I'm going to add a little bit extra. I think especially if you live in a high cost of living area, add any outstanding mortgage debt on top of that too, because that's probably going to be a big pile of money. So if you put those two together, you'll have a much better understanding of what your risks are. So that's the guidance. It's not one times income, because one times income, especially if you're young and you have young children in the house, that could be scary.
Yeah, sure.
I mean, that's just because that's probably not going to wipe out the mortgage. That's also not going to help your spouse, as their world's already going to be really difficult and struggling. You want to make sure there's plenty of liquidity and access to resources. So I would go beyond that one times. I'd look at the 10 times. And then if you're really, if you're in a situation, this might be a financial planner type thing to really hone in and customize. But if your life's pretty simple, you can use some of these benchmarks and guidelines.
Yeah, what I think is interesting is this person said they're in their late 30s. They might say, okay, well, I make $250,000. Well, times 10, that's 250,
times
2.5 million, and then plus another $500,000. That's oh my goodness, $3 million of life insurance. Is that really what I need? Here's the good news. If you're someone who's buying term insurance and you're someone in your late 30s, there's a good chance that it's going to be relatively inexpensive for the amount of coverage that you have. Now, one of the strategies you can do is, you may have an insurable need right now of $3 million, but 20 years from now, it might not still be $3 million. So you could actually look at staggering your policies. Maybe I want one policy that's 10 years that covers this much, and then another policy that's 20 years that covers this much, and then maybe I want a 30-year policy that covers this much. There are creative ways to solve that problem in a really cost-effective manner, but you kind of got to think through it. Whenever I sit down with couples, I always say, hey, hey, spouse one, if spouse two were to pass away, how much money would you need to be okay? And that's like a really weird question to ask. But that's really what you're saying is if I were not here to provide for my wife, how much income would we need to replace since I could no longer go out and earn that and do that so that she could pick up the pieces and continue raising our girls and continue doing all the things? That's really the conversation to have. And in most situations, one times income probably won't get that done. Now, there is a caveat. Let's say that you're someone who's been building wealth and you're getting close to financial independence, and you say, you know what, if I got taken out by a bus tomorrow, we've got a big enough portfolio that my spouse and my family will be taken care of. You may no longer have an insurable need. I think a lot of clients find it really interesting when we tell them, hey, your insurance is coming up for renewal, but you've reached financial independence. You don't have to have life insurance anymore. Just because you're still living doesn't mean you have to have that if that money's not needed to protect those that depend on you. So it depends on your life cycle.
I do want to give one caveat to that because
Sure.
I have this conversation all the time. A lot of you guys might have 20-year or 30-year term insurance. And yes, you've reached financial independence because you're great financial mutants. You've been saving. But realize that policy, especially as you get into your 50s and 60s, if you're only paying a few $100s a month because you bought that policy when you were in your 40s and you were much cheaper to insure, don't just throw it away.
Yep.
I mean, I tell this, and it's kind of it's just the cost of what the premium to what the level of insurance you're getting is so powerful. I don't want you just throwing those policies away just because you've reached financial independence. You need to do a value analysis to say, look, this policy premium is $300 a year. I'm getting
This benefit,
$750,000 worth of coverage. It might be worth for the next 5 years, because that's when the term expires, just to pay $300 a year just in case. I want to throw that caveat because I don't want people to say, ding, ding, ding,
Oh, I need
I've
to go
reached
cancel,
financial
yeah.
independence. Let's go cancel this term policy. There might be a situation where you're paying way less than the actual value of that policy just because you bought that policy 20 years ago.
Yep. Love it.